What we saw yesterday was Trump go big, and this is the culmination of a decade's worth of political work. I mean, that really is, when he first came down that escalator in 2015 and announced his run for the presidency, tariffs and trade were at the center of it. And it's almost as if he's been frustrated in his efforts in his first term and what we've seen since. And this time around, he's coming out and he's hitting big. This is we don't like to throw it around here at Bloomberg, but yesterday was a historic day in terms of U.S. economic policy. This was the biggest increase in tariffs we've seen in more than a century.
Yeah.
This is bigger than the Smoot-Hawley tariffs of 1930, which prolonged the Great Depression, set off global trade wars, and for a long time were this kind of cautionary tale for American presidents. Well, Donald Trump set aside all of that history and tried to make some of his own yesterday.
Well, so Anna, on that point, if we're using history as a guide, knowing that these tariffs are even more severe than the ones that Shawn was just referring to, what should we expect in terms of short-term economic impact?
Yeah, so what we have right now is models and also 1 month of trade data so that we can, and also price data. So based on the models, and I will refer to the one that the Fed used in predicting the tariff impact from 2018, it would suggest that the GDP hit would be about 2.8% in total, with most of it hitting in the first year. And in terms of the core PCE inflation impact, it would be about 1.6%, with about 1.1% hitting in the first year. So that's what the model suggests. So now we have some actual data. We have February's import price data, and we have also PCE inflation data. Looking at the imports price data, I would say that it shows that so far the tariffs on China, we saw 10% increase in tariffs on China in February. We've seen that U.S. importers took on most of the cost. But there's still a distance between import prices and also what the final retailers charge, such as the retailer Zara or Forever 21, right? So in terms of the core PCE prices, based on 3 months change, we actually have found a negative relationship between import exposure and actual price change. In fact, the apparels, furniture, stuff that we import a lot from China actually saw a decrease in prices over the last 3 months. And it's kind of counterintuitive, but I think the reason is because a lot of firms have been front-running these, so we haven't seen yet, at least so far, the inflationary impact, if there were to be any. And second, also consumer sentiments in the U.S. have tanked, and they're just pulling back on anything discretionary, such as toys and books and and clothes. And I think, for anyone who's going on Amazon, for example, you could see that a lot of these goods that you're buying from China actually are seeing price discounts right now.
Shawn, is there any way to quantify the front running that we've seen, companies that have tried to grab as much material as they can, suggesting that it could be months before we really see an impact when they're going to buy new goods that are tariffed?
Yeah, look, I mean, we're going to be spending months trying to figure out what the impact of this is. Yeah, we've seen inventories build up. We've seen a surge in imports starting after the election last year, to try and get ahead of this. There were some smart buyers out there who knew something was coming. But, there's all these broader effects on the economy that are really, really hard to price in. One of the big things that's gotten markets agitated in the last couple of weeks has been consumer sentiment, right? That is not something that is, and Anna may correct me, but I don't think it's something that's in a lot of economists' models in terms of the direct impact of these tariffs. There's this broader thing, which is kind of amorphous, but very real, which is uncertainty, right? We know back in 2018 and 2019, the Federal Reserve, when they were watching the U.S. economy slow down as a result of Trump's first-term tariffs, they were looking at uncertainty and its impact on business investment and hiring, and that actually turned out to be a bigger impact than the direct impact of the tariffs.
Wow.
So you stack all these things on top of each other. A lot of people in the markets and in business were hoping that yesterday was going to be the end of a period of uncertainty. We're extending that uncertainty. We're probably deepening that uncertainty in a pretty severe way.
So in that uncertain environment, and with payrolls data in hand that we'll get tomorrow, Chairman Powell is going to have to speak to the financial markets. in less than 24 hours from now. How do you expect him to approach this, knowing he has very much said the Fed is waiting and seeing, we're not going to be too reactive, we can't predict for sure what the policies will look like. Now that we have a sense, how does he respond?
So I think Chairman Powell is in a pickle because after the FOMC, he presented a very dovish voice, which was in huge contrast to the rest of the FOMC, who are more concerned about the upside risk to inflation. And since the FOMC, we have seen more of other FOMC policymakers who sounded way more hawkish concerned about these tariffs. So I think Powell may have to do a course correction because since he last spoke, we now have more clarity about what these tariffs may look like, who we are tariffing on, what goods we have tariffed on. He cannot afford to waffle anymore or play the game. He has to get in line with the rest of the FOMC makers. So I think he may be surprisingly hawkish tomorrow.